All right. Hello and welcome to the regularly scheduled Q&A session through the private practice owners community on School. I appreciate you being here or watching this recording. We've got a number of questions from folks this week, so I'm going to be diving right in shortly, but just as a reminder, we do these every 2 weeks. So if you have a question, financial, business related, or whatever, feel free. Send me a DM, post it in the community, whatever you'd like, whatever is easiest for you. And we'll be sure to answer them either on the community or here. Just keep that in mind, especially as like business issues come up and whatnot, because I know it can feel a little isolating at some point, at some time when you're in private practice. And I'm here as a resource to help with that. So got a number of questions I said, and then if you are here live and want to add a question in the chat, feel free to do so. I've muted everyone, so you're gonna have to use the chat, and that's just so you don't accidentally get recorded as I'm recording this. But in the meantime, I'm gonna start with some of the questions that I got, via DM. So first question comes from someone who said they're dealing with a divorce and they're having trouble to manage the investments that they're receiving from their ex. And so they're wanting to know how to use them properly and what should you be thinking about as that person decides. And really, this is an interesting question. It's not uncommon. I have a couple clients going through this very experience right now. And really, what you need to start off with when you're sort of figuring this out is what your goals are with the money. Like you're going through a very emotional and big experience in your life, and understanding what your life's going to look like in the next year and 2 years to come is going to be really important. So like when you're receiving investments, how are they being delivered? Are they through a 401k? Are they through a stock plan? Are they through an IRA? We need to know, because we need to know how much access you have to those accounts, and then determine what your goals are. Say, buy a house, because maybe you no longer live in the home that you previously lived in. And so that's one thing we need to consider. Do you need to buy a home, and are you going to be using some of the funds from the investments in order to afford that home? If there's other goals that you may have, whether it's moving, whether it's like big life changes, let's consider that first and then figure out a plan for the investing side. And the investing will be dictated by whatever those goals are. If you're really not doing anything new and you're just planning on keeping those in investment accounts, then we just need to figure out the best way for you to either roll them over into an account that you own or some other sort of strategy, just to make sure that it's invested for the purposes of long-term goals that you have. But really, we want to start with that goal perspective and then go from there. And then just some things to think about, like if you're getting 401k funds through what's called a QDRO, then you may want to be rolling those over into an IRA so you aren't being charged a 401k fee, or you have more options to invest and that sort of thing. And then if you're getting stuff like a stock plan or something like that, and it's from an individual stock of your ex's employment or something, what we really need to understand is when you would be taxed on those, if at all, and if you're not at all, how we can then move them over into a more diversified investment strategy. And so those are two common ones that I see that require immediate and awareness of the long-term impact, because we want to make sure they're accessible to you, they're as tax advantage as possible, but also you're investing from a diversified perspective. Hopefully that helps. And I know that's always a tough situation. So, good luck as you're sort of wading through that. The second question was about an HSA. So this person says, they have access to one, but they're not sure really what it's for, what they're doing with it. And so they've just asked for a quick explanation. So an HSA is what's called triple tax advantage. It's the only tool in the universe of U.S. investing tools that isn't taxed when you put the money in, isn't taxed as the money grows, and isn't taxed when you use that money if you're using it for medical expenses. And so that's why it gets that triple tax advantage name. And the reason you have access to it is because you have a high deductible healthcare plan. When you have a high deductible healthcare plan, they have to give you access to what's called the HSA. And so what happens is you can put money into the HSA and use it for that year's health costs if needed. And it's perfectly reasonable way to use the HSA. You're just essentially getting this money tax-free now and using it for medical expenses. So it reduces the overall cost of the medical expenses because you're not paying taxes on that money. But a lot of times what people will do is take that money in the HSA and invest it. And if you invest it for the long term, it continues to grow just like an IRA, but it keeps those HSA sort of rules. So you're not taxed when you put it in, it's not taxed as it grows. And if you use it for medical expenses in the future, it's tax-free as well. And so that's really valuable, especially since one of the bigger costs that you're going to experience as you get older is really healthcare costs. And so if you have a large HSA by then that can be a great way to, manage those costs from a tax-free perspective. And I would also add that the 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 value of it grows. I mean, the value of it when you're first starting out it's really valuable. And so like even if you're just doing a little bit to a 401k and a little bit to an HSA, that's like a good use of the HSA, but it grows even as you're like topping out other accounts. Because if you have the high deductible health plan, there's no income limits or anything like that. So you're like able to continue to fund that. Whereas say a Roth IRA, which is growing tax-free, there are income requirements in place. Hopefully that gives you a little bit of an explanation. And so you really just, I would say the first step is really just to figure out, do you want to use that HSA to fund current dollars or to fund current health expenses or to fund future health expenses? The third question that I received, it seems like building an emergency fund will take me forever. Are there other ways to create this, or am I doomed to save for this for years to come? Hopefully not doomed to save for years to come. Essentially, when you start saving towards an emergency fund, what you're gonna find is your efforts are going to increase considerably and quickly. And so hopefully that is not the case where you're saving forever and ever and ever. But there are other ways that you could do this, and you really just need to look at your asset base and the assets that you have available. And by assets, we don't just mean the cash on hand. We mean your investments, we mean your house, we mean other things. And so you could potentially fund it in other ways. It's a question of whether you want to, because there's downsides and benefits to both. Okay. So like, let's say you have a large investment account. You're not really worried about your investments, but you really want that emergency fund. Well, maybe it is useful to take a small distribution from those retirement accounts so you have enough cash on hand if you need it. You have to weigh that. I mean, you have to weigh that against your future. You have to weigh that against the taxes that you would be paying. But it's not uncommon for people to build an emergency fund that way. If you have a house and you've built equity into the house and you want to take out a home equity loan, that is another way to fund it very quickly. Of course, you're paying back that loan and at a higher interest rate, so it's not the cheapest way to fund the emergency fund. But if you need it in place quickly to reduce anxiety, reduce your stress, maybe that is a way. The other thing is like if you have assets like art or something like that you're not super attached to, but they're valuable. Maybe this is a good reason to sell it now, because that would put cash in your hand, and you're just selling an asset that you don't have a ton of affinity for or something like that. That's also a possibility. So look at basically my suggestion is to look at your total asset base and really figure out sort of the most tax advantage way to do that. And, that's not always an easy answer because then you would have to know which ones are tax advantage and which ones aren't. But at least they'll give you sort of a stepping stone. And of course, as the courses go along, we'll be sure, I'm going to be explaining more and more of the tax side of things. And so hopefully they'll help like ease that dynamic. Are there any insurances I should be thinking about? I'm a newish private practice owner with two young kids. So definitely, with the two young kids, we're always looking for term life insurance, partly because we just want to make sure they're protected in case something happens. And term insurance is about as cheap of insurance as you possibly get. You have to determine how much you can afford, how much your kids will really need. But to get, a 400, 500, 600, $700,000 policy is, maybe 400 to $700 a year or something like that. And so it's not super expensive, and it does its job. It covers that risk. And that's really what we're getting insurance for, is we're covering the risk that we can't, if they hit, we can't afford in any other way. So we can't necessarily afford the fact that we no longer will be making any income because we're no longer here and our kids are unprotected. But term insurance is a very cheap way to do that. And so we're passing along that risk to the insurance company. Uh, Avoid things like whole insurance and universal index insurance and things of that nature, just because what they're doing is taking the risk and creating an insurance product around it, and then also saying, hey, you also need to invest. And those are two different needs: need to insure, need to invest. And let's put this into one combined product. And really, what happens is it's inefficient at both, it's expensive, and there's better ways to sort of manage those two risks. And so, because of that, I'd really just look to term insurance. And then if you're a new private practice owner, you really need to be looking towards long-term disability. Like our biggest risk as business owners is a car wreck or an accident of some kind that leaves us unable to work and needing care. And that's really what happens with long-term disability. And so essentially what happens is our income drops, but our needs rise. And we have no way to really protect ourselves other than long-term disability from that risk. And it's much more likely that were to happen than, say, passing away or something like that. And so it's unfortunate. It's one of the first conversations I typically have with clients is getting long-term care, long-term disability, not long-term care, but long-term disability insurance. And so I would strongly advise looking into the idea around that. Here's from the chat. Is there any trick to finding a high yield savings account? They're trying to build the cash and unsure what to select. So the trick is really to figure out how you bank and then find a bank that has a high yield savings account interest rate that's competitive, that matches the way you bank. So competitive right now is anywhere between 4 and 5%. So if you can find a high yield savings account for 4 and 5%, that's really good. And then in terms of how you bank is like, do you like to go into a bank to actually put cash in? Or do you never go into a bank and you can completely use a digital bank or an online bank? Because the difference matters, and which one you select is going to determine how you bank with that bank, right? Like for me, I never go into a bank, and so I have a online bank that has a 4.25% interest rate, and it works for me. Like I've had to have them send me a check like once or twice when I was like buying a car, but that's about it, and that's totally fine for me. But if you are someone that needs a brick and mortar store, then make sure to select one, and you can look local, so a local bank as well as like a large national bank that has a footprint in your area, and just compare the rates. Do they have a competitive rate in that 4 to 5% range, and do they have low fees? Meaning, like if you put $1,000 in the savings account, there's no fees, because you want to make sure like that interest rate isn't getting cut into by fees, and so you just want to make sure that it's got a low minimum, so no fees, and that 4 to 5% interest rate, and that it allows you to bank how you want to bank. Hope that helps. Are there ways to increase my rates? I'm looking at doing this, but not sure how I can while managing my current caseload. Yeah, so I would say that like if you are sort of in a point where you want to raise rates and you haven't done so yet, it's now time to start. That next person that comes through, let's start increasing that rate. And you can slowly, methodically do this. Of course, if that person comes through and you want to work with them, but they are acknowledging that they have poor financial situation and you can still work within whatever sort of fee that they can provide, maybe you're going to do that. But if that nurse person comes in and they're not really concerned about the finances and whatnot, then let's start testing the limits of where your rates are. I mean, of course, do this ethically. I'm going to rely on you from an ethical standpoint because everyone sort of has different opinions about that. But however that looks to you, you need to kind of see where your limit is, what your customers' limits are, or your clients' are limits are, and then keep testing that and keep testing that and keep testing that because you're never going to know how high of a rate you can get until you start doing that. The other way is really to start testing out other models. So concierge therapy is starting to become a thing where you essentially get more access to a therapist, more ability to see them, but you're paying like a higher rate and maybe locking in for a certain amount of time, that sort of thing. Of course, it has to reflect whatever the care plan is. But working with those who are interested in the concierge therapy idea would also increase your rates because you can also then increase your rates across the board, um, even if you have a sliding scale in some way for those who are not looking for the concierge. And that could be really valuable because now let's say you're getting $1,000 a month from a client that sees you twice a week, but they have access to you if they wanted to see you 4 times a month or something like that. But they're only coming in twice a month. And but they're well aware of it. It's perfectly above board because they've signed off on it. They agree to it. They are willing to pay for that access. And sometimes they just don't need that access, but that's okay because sometimes they will. Um, and it's important that you're there for both sides of it. But that's another thing that one, you see a lot in regular medicine, and I suspect you're going to start seeing more in the therapy space because I know in New York, where I'm based, I'm already starting to see it. And so that would be another way. But you can look at other models as well that could help you increase the rate, whether it's a group session. So now for an hour, you have a group session that everyone's paying you, $50. If 10 people show up, that per hour rate looks great. That's another sort of tactic. But play around with it, test yourself, and get just kind of, you're gonna have to get a little bit comfortable with asking for a higher rate because again, you're never gonna know how much you can ask for until you ask. Any other questions from the chat? Not right now. So the other thing I wanted to show you are the two calculators that I've put together, which you probably saw on the school community. And I just want to walk through them real quick. They're very simple calculators. I'm sure that you can uh, manage this on your own, but while I have the time, I thought I would share. So the first one is setting your rate calculator, which is very appropriate for the last call or for the last question, actually. And essentially, when you're setting your rate, you're going to have to, of course, weigh the ethical side of it, what you're comfortable with. Like, again, this is just dollars and cents side of it. And so I'm going to leave you for the ethical side, but I'm just going to show you how I suggest starting and setting that rate, at least at first. And so really where I want to start is what is your desired yearly income? Um, and this is essentially your revenues. So not your after taxes number, but before tax number. So let's say your desired yearly revenue figure is 200,000. And then you need to kind of estimate how much business expenses you're going to have. With $200,000, I'm going to guess that you're having around 30,000 in expenses, but you need to kind of pinpoint this to what you think. Um, and about your business. So if it's lower or if it's higher, and depending on sort of how you get clients and whatnot, then feel free. Do whatever you like. Keep that number as close to you as possible. Average sessions hours per week. So this is how many clients you see per week at whatever rate you're going to charge. And so let's just say it's 25 since that's a common number. And then I choose 48 weeks in a year because I want to make sure that you're building in time for vacation and you're building in time for holidays and that you're still able to reach that mark. Um, Often, people say, I want $200,000. This is a business of expenses and work 25 hours a week, and we're going to work, there's 52 weeks in a year. And so therefore the mark's going to be much, the average hourly rate's going to be much lower because you have more weeks. But then what's going to end up happening is you're going to get sick. You're going to take breaks for holidays. You're going to take breaks for vacation, and you haven't accounted for that in the rate. So you need to make sure to do that. And that's what this calculator does because it essentially takes the 25 hours per week, times it by 48 weeks, which is 1,200 hours per year, and you are just under $200 per session, which is why that $200 mark is so important in this space because of those who need to get to that 200,000 revenue mark, they're going to have to charge about $200. So that's why. Um, Hopefully that makes sense, but that's really where I would suggest starting with setting your rates is where do you want to be at the end of the year? Let's start there, and then let's find a rate that matches that. The emergency fund calculator, this is even more straightforward, but I wanted to make sure that you know what you're doing. So you don't have to put in all the weekly expenses, all the monthly expenses, all the yearly expenses. This is going to automatically sort of estimate for you. And so you just need to fill in one. So we're just doing personal expenses here. Let's say the monthly expenses is $6,000. Okay. And that includes your rent or mortgage, as well as all the groceries, all that sort of stuff. Okay. And then you want to then say how much do you need for to cover? So how many months of coverage do you want? Let's just say 3 months, because we're going to do 3 months in the personal and 3 months in the business. And so that means that's how much you're going to save. It's 18,000. 6 times 3 is essentially the same thing. So this is not complicated math, but sometimes it's just easier to put it in like figures like this. And so that's why. But also it could be like, you know, 7320 or something like that. Um, oops. And, so there you go, $22,000. So just something to keep in mind. And if you want to use it, feel free to use it. Same with the business expenses, works exactly the same way. Say it's 4365 and 3 months, $13,000. On the business expenses, you may want to account for your salary, so that would then increase this a good amount. And that's just so in case like hours are hit or something like that, you're still paying yourself the right amount, and you have enough buffer here for whatever sort of slowdown to rewrite itself. And so that's why. Let me just make sure. Okay. And then one last thing is I wanted to touch on something I posted on just because I wanted to give you a heads up on it. This is the W-2 equivalent. I think it's an interesting chart. There's not a lot of workable advice from it, but at least it gives you sort of a sense of where you kind of stand. The one thing I would add though is I realized that Social Security you are paying into until about 164, 169, I forget what it is this year, but $164,000 in income. And so once you're over that mark, you no longer have to keep paying for it. So these top lines right here uh, aren't accounting for that. And so it's a little closer to what this income might be. And so that's just a heads up there. I will probably make that switch at some point. It's more impactful here, but this $10,000 expense is probably not very accurate. So let's like take a $30,000 expense if you're making that much. I mean, we're only impacted like at the top two levels. So it's very small impact, but I just wanted to give you a heads up there. And then also these are not accounting for variable costs. Like, so, someone in the school community mentioned healthcare. I can't build this into healthcare because healthcare is so different depending on what state you are, how big the group is, that sort of thing on the W-2 equivalent side. And also sort of the health situation and how much healthcare you need and coverage you need and stuff like that. And so because I can't really do that, I can't incorporate that. I can incorporate expenses. And so the healthcare kind of wraps into the expense line a little bit, which is something that like W-2 employees don't have to pay, and they have to pay less for healthcare in general. So it's kind of wrapped into that a little bit, but it's not like a one-to-one. So just wanted to give you a heads up there. Instead of trying to keep this as high level, broad as possible in order to uh, just kind of provide a snapshot of kind of what these look like on the W-2 equivalent side. But I hope that helps. And if you have any questions about the calculators, anything I said today, even the W-2 equivalent, just let me know. Like just post, like feel okay posting on the school community. No one's judging you for a bad question or anything like that. And probably if you have that question, someone else does as well. So I would encourage you to do that. But otherwise, we don't have any more in the chat. So I think we're going to wrap up for right now. But I appreciate you coming. I appreciate you watching if you're watching the recording. And I will talk to you in 2 weeks. Have a good one.